Hi, good afternoon. My name's Glenn Royal. I'm the Chief Investment Officer and a partner at RHP Wealth Management. Welcome to this month's Market Minute. We're coming to you at a time of a lot of news. We've launched a war with Iran in the last week, and that has boiled over to impact on global energy prices. What's interesting is about Iran's situation in the world as it relates to energy. It's about 3% of global oil and energy output, gas products, about 11% of OPEC's operating output, but when combined, what passes through the Strait of Hormuz, that important body of water, is 20% of the global oil capacity in this world, energy production. That's what's got everyone's attention, as well as the retaliation Iran has done versus its neighbors in this Gulf War. But let's back up just a minute before this started. Before the war started, we had a situation where hedge funds in general we're having questions about the return on investment in AI, the concerns that AI would start impacting large software companies and impacting their future selves. So we were already having a bit of risk off with the big Mag 7 stocks going into this. You combine that with what's happening with the energy story with hedge funds that were actually quite short this market. When this news hit, we had a rapid downdraft. On average, we fell about 2% on the S&P 500 during the first week of the war. If we look at past geopolitical risk events, the average decline is about 4% during that first week. What we also see is it takes on average about a month for event risks that impact markets to recover. So while the market is seeing this as a risk off moment, it is aware of the history that shows there is recovery from this. Now, what we're seeing today is a sign of what recovery may come like. It could come fast and furious. In the case of in oil, we walked in this morning with looking at oil spiking up to nearly $119 a barrel. Huge, average price is $70 to 119. But as Trump mentioned this afternoon, that the war efforts may be coming closer to an end, you've seen a $32 price change in the barrel of oil down to from 119 down to about $87 a barrel a day. As a result, equities across the board have gone green, and that's the nature of these kind of markets when you have event risk, particularly with hedge funds that have large short positions that they're having to cover and scramble. I think today was probably more indicative of a short squeeze when we had these big pops rather than the beginning of any type of base case to get long and invest in this market. There's still too much uncertainty as it relates to the Middle East, and we need to work that out. The thing I would point out, as long as the Straits of Hormuz are closed and oil trends and stays above $100 a barrel, the greater impact we're going to see in a stagflationary type movement here in our economy. At the moment, if this thing ends fairly quickly, perhaps it's like another Venezuela and we'll start to look through it and move on, but time will tell. Natalie and I are going to have a fuller developed discussion around this as we release a podcast tomorrow. We hope you would stay tuned and listen to that for a little deeper dive in what we're seeing. But at this moment, we just want to be very brief. Just to let you know, there's a lot of fast action and volatility in the markets. Our base cases still remain the same. With oil coming back and staying below $100, that gives us a little greater confidence in that. But our base case is that earnings growth will be here this year. We will see interest rates rather stable, but we do need to get through these first few days of this war and see how this thing shakes out. It could certainly get better. It could certainly get worse. We just don't know at this. It's too early to say. But please stay tuned for that podcast. Look for that to come out. And thank you as always for your the time that you give listening to these podcasts. And any questions that you may have, please reach out to any member of the team here at RHP. We'll be happy to help you. Thank you.